So if we look back at 2001, Enron looked like, I mean, literally the most profitable, innovative company on the planet.
Oh, absolutely. They were the golden child.
Right. The stock was soaring. Wall Street analysts were universally screaming at people to buy it. And, their reported revenues were just astronomically high.
Right. On paper, they looked unstoppable.
Exactly. But if you knew how to look under the hood, like if you bypassed all the hype and looked at one specific financial statement, you would have seen that their actual bank accounts were, well, they were bleeding dry.
The money just wasn't real.
It wasn't real. Millions of investors lost everything because they were looking at, the stock's popularity instead of the actual mechanics of the business.
And, the crazy thing is it happens over and over again. It really does.
Yeah.
The visual of a stock chart, right?
Yeah.
With its constant stream of flashing red and green numbers, it induces this intense sense of urgency.
Oh, totally. It's like a slot machine.
Exactly. It tricks the brain into thinking investing is this high-speed reaction game. But relying on momentum or, headlines without understanding the underlying financial engine is, well, it's like trying to fly a commercial jet by only looking at the altimeter.
Wow, yeah.
I mean, you might know how high you are in this exact second, but you have literally no idea if you have enough fuel to actually reach the destination.
That is a terrifying thought. But for you listening, if you've ever felt that intimidation, if you, already know the basic vocabulary of investing but still find yourself paralyzed when trying to figure out if a company is actually a smart buy today,
Yeah.
then this deep dive is for you.
Mm-hmm.
We are analyzing a single, incredibly focused source today. It's a comprehensive video guide on fundamental stock analysis. And our mission here is to basically transform that wall of chaotic data into a structured, step-by-step approach for evaluating a company's financial health and its future potential.
Yeah, the intention really is to just strip away all the noise. Because evaluating a business, it doesn't require insider information, right? It requires a logical sequence of deduction. And the source material we're looking at, it outlines exactly how to move systematically, from gathering context to interpreting the math, and finally to making a final, completely emotionless decision.
Okay, let's unpack this. Where is the absolute starting line? Because I feel like usually the temptation is to just pull up the ticker symbol, look at the quarterly profit, and, make a snap judgment.
Yeah, and that is a huge mistake. Jumping straight into a company's individual numbers without looking at its environment is a massive blind spot.
Really?
Oh, yeah. The foundation of any analysis, the very first step, it has to be the broader context. You have to identify the stock and immediately research the company's background and, critically, the industry that it operates in.
Okay, I think of this like buying a piece of real estate, right?
Oh, that's a good way to look at it.
Like imagine purchasing this beautifully renovated property without ever actually looking at the neighborhood.
Right. You just look at the house.
Exactly. You can have a pristine foundation, a flawless roof, top-of-the-line appliances, Yeah. But if the local economy is shutting down, if the major factories nearby just closed and everyone is moving away, the value of that beautiful house is going to tank.
Oh, 100%.
The structure itself is sound, but the macroeconomic environment around it is just collapsing.
Yeah, the industry is the neighborhood. That's exactly it. I mean, a company producing cutting-edge luxury goods might have incredible profit margins right now.
Right.
But if you haven't researched the industry context, you might miss that their sector is hyper-cyclical, and incredibly sensitive to interest rate hikes. So if borrowing money suddenly gets expensive, consumers just stop buying luxury goods. It doesn't matter how well-run that specific company is. You have to establish the baseline of the environment before you can judge the performance of the player within it.
Okay, so once we have that neighborhood mapped out, we transition from the macro environment to the internal reality of the company itself, right?
Step 2.
And the source really emphasizes looking at the big three financial statements: the income statement, the balance sheet, and the cash flow statement. And assuming you listening already know your way around a basic asset or liability column, the real insight from the guide is how these three documents have to be read together to spot red flags.
Yeah, and what's fascinating here is that these three documents are the absolute bedrock of truth for a company's financial performance.
They don't lie.
They don't. They cut through the narrative. I mean, a CEO can go on all the financial news networks talking about how, their new AI integration is revolutionizing the space.
Right, all the buzzwords.
Exactly. But these statements, they do not care about press releases.
They are the actual receipts.
Yes.
And they each measure a completely different biological function of the business. Like you can think of the balance sheet as a blood pressure reading.
Okay, I like that.
It's a static snapshot at one specific second in time showing the overall pressure in the system.
Hmm.
Like, are they carrying a dangerous level of debt relative to their equity? But then the income statement is more like a fitness tracker, measuring activity over a full year. It shows profitability over time.
That's a great analogy. And the cash flow statement then is the actual oxygen supply.
Oh, oxygen?
Yeah, it tracks the literal physical dollars moving in and out of the company's bank accounts. And this is where you catch discrepancies.
How so?
Well, a company can look incredibly profitable on an income statement because of accrual accounting.
Right, where they count money they haven't actually gotten yet.
Exactly. It means they book the revenue the moment a client signed a contract. But if that client hasn't actually paid the invoice yet, the cash flow statement will show a gaping hole.
So they look rich, but they're broke.
Essentially, they might report a record-breaking profit on paper, but not have the physical oxygen, the actual cash, to make payroll on Friday.
Wow. Okay, so we've checked the neighborhood, and we have the receipts. We've verified they aren't manipulating their profits and that they actually have cash in the bank.
Mm.
But raw profit doesn't really tell me if the stock itself is actually a good deal today,
Right.
right? Like a genuinely great company can still be a terrible investment if you pay way too much to own a piece of it.
That is the crucial pivot. We have to shift from absolute numbers to relative value. We actually have to do the math to understand how the market is pricing those profits.
Right, the valuation.
Exactly. And the guide points heavily to the price-to-earnings ratio, the PE ratio, as the primary mathematical shortcut for gauging that value. You're basically taking the current price of a single share and dividing it by the company's earnings per share.
So logically, it's basically asking the question, how much money is the market demanding I pay right now for the right to own one single dollar of this company's profit?
Spot on. And the guide notes that a lower PE ratio may indicate the stock is undervalued.
Okay.
Like if you're paying $10 for every dollar of profit while a competitor's stock forces you to pay $30 for that same dollar of profit, you are objectively getting more current earnings for your investment dollar with the first company.
See, let me push back on this a bit, though.
Sure.
Because, if it were simply a matter of hunting down the lowest PE ratio on the market, you wouldn't need a deep dive, right? You'd just need a basic sorting algorithm.
Yeah, a simple scanner.
You could build a program to auto-buy the bottom 20 PE ratios on the exchange and retire a billionaire.
Mm-hmm.
But the source uses very careful language. It says a lower PE may indicate undervaluation.
Yeah.
So does a lower PE ratio guarantee a stock is a great buy, or is the source careful to say it only may indicate undervaluation, meaning we need to keep digging?
It absolutely does not guarantee anything. Never. A low PE ratio is a starting bell. It is not a finish line.
Okay.
Because often a stock is cheap for a very, very terrifying reason. This is what we call the classic value trap.
The value trap, yeah.
Yeah. The market might be pricing a stock at a remarkably low multiple because institutional investors know the company's core product is about to face massive regulatory hurdles. Or, maybe a key patent is expiring next month. So the current earnings look great, making the PE ratio look artificially attractive.
But the market expects those future earnings to just fall off a cliff.
Precisely. The market is incredibly forward-looking. A low PE can simply mean the market has already priced in an impending collapse.
That makes a lot of sense.
And conversely, a high PE ratio isn't always a bad investment. Like, a tech company might have a PE of 80 because the market correctly assumes their earnings are going to quadruple in the next 2 years as they scale a new software platform.
Right, they're pricing in the growth.
Exactly. Which, this raises an important question. How do you separate a genuine bargain from a value trap?
Well, I'm assuming you can't just rely on a static snapshot of today's price and yesterday's earnings.
Nope.
You have to look at the velocity. The guide really insists we analyze the company's growth potential by looking at trends in revenue and earnings over time.
Yeah, trends smooth out the anomalies. A single quarter of explosive earnings, it could just be the result of a one-time real estate sale, right? Or maybe a sudden temporary spike in commodity prices.
It's not repeatable.
Exactly. By tracking the trajectory of revenue and earnings over a 5 or 10-year period, you filter out all that macroeconomic noise. You are looking for a structural compounding advantage.
Right.
Consistent, reliable growth proves that the underlying business model actually functions across different economic microclimates.
Okay, so what does this all mean? Let's say we've done all the forensic accounting. The cash flow matches the income statement, the PE ratio sits at a comfortable level relative to historical norms, And the 5-year growth trajectory is just this beautiful, steady upward curve.
A perfect scenario.
Right. On a spreadsheet, the company is an absolute powerhouse. But, numbers don't exist in a vacuum. A flawless spreadsheet can still be completely dismantled by real-world friction.
Oh, absolutely. And this is where we have to pivot from the quantitative to the qualitative. Step 5 in the guide's framework focuses entirely on market conditions and the competitive landscape.
Because the math isn't enough.
Right. Mathematical undervaluation is totally irrelevant if a disruptive technology makes the entire business model obsolete overnight.
Yeah, the financials only tell us that they won the game yesterday. They don't tell us who they are playing tomorrow.
That's a great way to put it. If we connect this to the bigger picture, evaluating competition bridges the gap between historical data and future survival. You really have to map out the economic moats.
The moats.
Yeah, like, does this company have a durable competitive advantage? Are there high switching costs for their customers? Is it a proprietary technology?
Okay, I see.
Because if a well-funded competitor enters the space tomorrow and they're willing to operate at a massive loss just to steal market share, how protected are those beautiful profit margins we just calculated?
That is such a good point. And that inevitably brings us to the human element, doesn't it?
Mm-hmm.
The guide's next core focus is evaluating management quality, company culture, and market position.
Yeah, and these qualitative factors, they defy basic calculation. I mean,
Yeah.
you can't divide a CEO's vision by a share price.
Right, you can't put that in an Excel cell.
No, you can't. Yet the source makes it abundantly clear. Strong leadership is often the singular variable that dictates whether a company survives a crisis or not.
I always go back to a sports analogy for this.
Oh, let's hear it.
You can analyze a team's roster and find incredible individual player statistics, right? They have elite historical win records. Their offensive metrics are phenomenal. That's your historical financial data.
Mm-hmm.
But if the head coach is entirely inflexible, or if the locker room culture is completely toxic, they're going to collapse in the playoffs. The historical stats are completely meaningless if the leadership can't adapt to an unexpected defense on the field.
That is exactly it. And the mechanism for evaluating that leadership, since, we can't literally sit in the locker room or the boardroom, is looking at capital allocation and past behavior.
How do you do that?
Well, you can go back and read the transcripts of earnings calls from, say, 3 years ago. Did the management team actually execute the strategic pivots they promised back then?
Oh, holding them accountable to their own words.
Exactly. When they had excess cash, did they intelligently reinvest it into research and development, or did they blow it on an overpriced acquisition just to inflate their short-term revenue numbers?
Wow, yeah.
A company with average financials but elite, adaptable management will frequently outperform a fundamentally strong company run by a stagnant, arrogant executive board.
Okay, here's where it gets really interesting. Because we have gathered an immense amount of data at this point. We've defined the industry context, we've dissected the bedrock financial statements, analyzed the mathematical ratios, plotted the growth trends, and audited the competitive and managerial landscape.
It's a lot of work.
It is. And the culmination of this entire step-by-step process is finally pulling the trigger. The guide demands that the investor synthesize all of this intelligence to set a specific target price.
Yes. The target price is the ultimate translation of all this theory into action. It is the specific valuation where you feel the risk-to-reward ratio is actually in your favor. And crucially, it must be derived logically from the preceding analysis, not just pulled from a gut feeling.
The source actually outlines a scenario with company XYZ.
Right, the hypothetical.
Yeah. So you run this exact gauntlet. The industry is robust. The cash flow is strong. The PE ratio indicates it's fundamentally undervalued. And the management has a proven track record of smart capital allocation. The mathematical and qualitative deduction tells you this is a phenomenal company.
And based on that analysis, you determine company XYZ is worth, let's say, $40 a share.
Okay.
That is your target price. So if the stock is currently trading at $50, the discipline of this process dictates that you absolutely do not buy it. You set an alert and you wait.
See, I have a question about that. How does establishing this hard mathematical target price functionally protect you from the psychological chaos of the market? Because, when you see a stock trending on social media or when it's jumping 5% in a single afternoon, the urge to just jump in so you don't miss out is almost biological.
Oh, it's incredibly hard to resist. But setting that target price, it acts as a Ulysses Pact.
A Ulysses Pact.
Yeah, it's a pre-commitment strategy designed to bind your future actions when you know you will be tempted by emotion. The market is literally designed to exploit behavioral flaws like FOMO, the fear of missing out.
Yeah, all the flashing
The
lights.
flashing numbers, the breaking news alerts, they trigger a real adrenaline response. But when you have a target price, you have essentially written a contract with your rational self.
I love that.
It shifts your role. You go from being a reactive gambler trying to catch a moving train to a proactive buyer dictating terms to the market. You are refusing to pay a premium simply because other people are currently excited.
It fundamentally changes your relationship with market volatility, doesn't it? Like, instead of a market crash causing you panic, a sudden dip in the market becomes the exact mechanism that triggers your target price. Volatility becomes an opportunity rather than a threat.
Exactly. The ultimate takeaway from the source material is that applying this structured approach, it simplifies investment decisions. It removes the mysticism from investing.
Yeah.
You don't need a high-frequency trading algorithm or a seat on Wall Street. By methodically layering context, financial reality, valuation math, and qualitative judgment, you build a fortress against emotional decision-making. It allows anyone to navigate the market with calculated confidence without being intimidated.
So, to summarize, we've walked through the entire architecture today. You now have a framework to look past the flashing red and green numbers. To tear apart the big three financial statements, to weigh the PE ratio against future growth, evaluate the humans running the machine, and lock in a target price that shields you from the hype.
You have the tools to decode the matrix, basically.
Exactly. But before we wrap up this deep dive, I want to leave you listening with one final, slightly unsettling thought to mull over on your own.
Oh boy.
If a company's past financials, its PE ratio, its growth trajectory, and its management history are completely public documents, and those documents are being analyzed by millions of brilliant people using these exact same logical steps every single second of the trading day, what hidden, unpredictable human variables actually dictate whether that stock drops to your target price tomorrow? Is the global market really just a cold, efficient calculator perfectly processing financial data? Or, when you strip everything else away, is that chaotic, zigzagging stock chart simply a mirror reflecting the unpredictable, deeply irrational psychology of human beings?
That is definitely something to keep in mind the next time you pull up a stock chart.